Stop everything you're doing right now. What I'm about to share with you has not been explained clearly on mainstream financial coverage, and that silence alone should make you pay attention. Over the last 72 hours, silver has moved into territory that reshapes the entire global metals market. Prices have crossed $82 per ounce, and behind closed doors, banks, manufacturers, and institutional traders are scrambling to understand what just happened. This is not hype. This is not speculation. This is a documented supply stress event unfolding in real time. Global silver inventories are tightening at a pace never recorded before, and decisions being made in the next 48 hours could define market outcomes for months or even years ahead. Information like this rarely reaches the public early, but today you are hearing it before the full picture becomes widely discussed. Before we go any further, I want you to pause for one moment. Comment below and tell me what city or country you're watching from. I want to see how far this information is traveling. Let us start. 3 days ago, a confidential industry briefing circulated among several major bullion market participants in New York. The document outlined an escalating difficulty in meeting physical silver delivery commitments at current demand levels. This was not an opinion piece. It was an internal risk assessment. Physical silver availability is tightening faster than expected, and delivery timelines are extending across multiple regions. As you watch this, industrial buyers are paying substantial premiums above spot price to secure immediate supply. These premiums are not being driven by speculation. They are being driven by necessity. Silver is essential to modern industry. Electric vehicle manufacturers require it for battery management systems and power electronics. Solar panel producers depend on silver paste for photovoltaic efficiency. Telecommunications infrastructure relies on silver for high conductivity components. Medical equipment uses silver for its antimicrobial properties. Defense and aerospace applications require silver for precision electronics and guidance systems. Unlike many commodities, silver is not easily substituted without performance losses. Recent data shows that exchange-monitored warehouse inventories have declined sharply over the past 90 days. This drawdown reflects both industrial withdrawal and increased investment allocation. At the same time, global logistics bottlenecks and reduced recycling flows have limited supply replenishment. Silver is consumed in microscopic quantities across billions of products, and once used, much of it is not economically recoverable. This creates a structural imbalance that builds quietly until it becomes visible through price movement. Investment demand has also increased. Exchange-traded products backed by physical silver have absorbed significant quantities over recent months. Retail demand for coins and bars in the United States has risen sharply compared to previous years. These flows remove physical metal from circulation and tighten availability for all market participants. What makes this moment different is timing. Several large futures contract settlement windows are approaching, and new margin and position requirements are scheduled to take effect shortly. Market participants must decide whether to roll contracts forward or seek physical delivery. These decisions concentrate pressure into a very short time frame. When physical supply is limited, even modest increases in delivery requests can create outsized effects. This is not a story about panic, it is a story about mechanics. Supply, demand, timing, and structure are aligning in a way that deserves attention. Understanding what comes next requires looking deeper into how the silver market actually functions. To understand why this situation matters, you need to understand how the silver market operates beneath the surface. For decades, the majority of silver trading has occurred through paper contracts rather than physical exchange. Futures, options, and derivatives allow participants to gain price exposure without ever handling metal. This system works efficiently as long as most participants settle financially rather than requesting delivery. The challenge emerges when delivery demand rises faster than physical availability. Recent positioning data indicates that open interest in silver futures represents a quantity of metal that rivals annual global mine production. At the same time, annual industrial consumption continues to absorb a large portion of newly mined supply. When you combine industrial usage, investment allocation, and contractual obligations, the margin for error becomes extremely small. Mining supply is not flexible in the short term. Silver production is largely a byproduct of mining for other metals, such as copper, lead, and zinc. This means silver output does not respond quickly to price increases. Even at elevated prices, bringing new supply online requires years of permitting, development, and capital investment. Recycling helps, but it cannot scale fast enough to offset rising demand from energy transition technologies. Government policy has also shifted. In recent years, silver has been recognized as strategically important due to its role in energy infrastructure and national security applications. This recognition has increased scrutiny on supply chains and long-term availability. Industrial users are securing supply further in advance than they historically did, which adds another layer of demand pressure. Market participants are now navigating a convergence of forces. Futures contracts approaching settlement, tighter margin rules, elevated industrial demand, slower supply response. These factors amplify each other. When one participant seeks delivery, another must locate metal. If metal is scarce, prices adjust upward to ration demand. This is not manipulation. It is basic market function. Premiums in the physical market offer real-time signals. Dealers report higher premiums and longer delivery times, not because of marketing strategies, but because inventory turnover has accelerated. Some products sell out faster than restocking cycles can replenish them. These conditions tend to appear before broader price revaluations become widely accepted. It is important to separate verified data from exaggerated claims. Inventory reports, industrial forecasts, and settlement schedules are publicly accessible. Anyone can examine them. What matters is understanding how they interact. No single data point tells the whole story, but together they reveal increasing strain. As prices rise, market behavior changes. Some participants reduce exposure, others seek protection. Industrial users prioritize continuity of operations over cost minimization. This creates a natural price floor driven by real-world necessity rather than speculation. What happens next depends on how participants respond to upcoming settlement windows. The market is approaching a point where physical reality asserts itself more forcefully. That process is rarely smooth, and it often unfolds faster than expected. At this stage, many viewers ask the same question. Why did similar warnings in the past not result in outcomes like this? The answer lies in context. Previous cycles lacked the same combination of industrial demand growth, constrained supply response, and synchronized financial positioning. The global push toward renewable energy has permanently altered silver demand profiles. Solar installations continue to expand year over year. Electric vehicle adoption accelerates across major markets. Grid modernization and data infrastructure require materials with specific physical properties. Silver occupies a unique position within this ecosystem. Unlike purely financial assets, silver serves both as a store of value and a functional input. This dual role limits how demand can contract during periods of economic uncertainty. Even when consumer spending slows, infrastructure projects and industrial processes continue. These users do not exit the market when prices rise. They adapt. Another factor is inventory visibility. Modern reporting standards provide clearer insight into warehouse levels and flows. When inventories decline consistently across multiple regions, it becomes harder to dismiss the trend. Market participants respond not to headlines, but to logistics. Price behavior also influences psychology. When long-standing resistance levels are exceeded, risk models adjust. Portfolio allocations shift, hedging strategies evolve. These changes can introduce new demand that reinforces existing trends. It is essential to emphasize caution. Market movements can be volatile. Prices do not move in straight lines. Corrections occur. Participation decisions should be informed, measured, and aligned with individual circumstances. Understanding is more important than urgency. What matters most right now is awareness. Awareness of how industrial consumption differs from financial speculation. Awareness of how settlement mechanics influence short-term dynamics. Awareness of how long it takes to correct supply imbalances once they emerge. History shows that commodity markets often signal structural change before consensus forms. By the time narratives solidify, price discovery has already occurred. Those who observed early had time to evaluate. Those who noticed late had fewer options. The coming weeks will provide clarity. Settlement data, inventory updates, and industrial procurement behavior will reveal whether current conditions persist or ease. Watching these indicators matters more than reacting emotionally to price swings. This is not about predicting a single outcome. It is about recognizing when multiple systems intersect. Energy transition, monetary policy, industrial logistics, and financial markets are intersecting here. Silver happens to sit at that intersection. So what should you do with this information? First, verify it independently. Review public inventory reports. Examine industrial demand forecasts. Follow settlement data rather than commentary. Knowledge reduces noise. Second, understand the difference between physical ownership and financial exposure. Physical silver represents direct possession with storage and liquidity considerations. Financial instruments provide price exposure with counterparty structure. Each serves different purposes. Neither is inherently superior. Context matters. Third, avoid emotional decisions. Markets reward preparation, not panic. Elevated attention often brings volatility. Volatility creates opportunity for those who understand structure and risk. Finally, recognize that this moment reflects broader trends. Resource constraints, infrastructure investment, and technological dependence on specific materials will shape markets for years. Silver is one example, not an exception. Whether prices continue higher or consolidate, the underlying dynamics remain relevant. Industrial dependence does not disappear. Supply development does not accelerate overnight. These realities anchor long-term behavior. If this is your first time examining the silver market this closely, you are not late to understanding. Awareness itself is valuable. If you have followed it for years, You recognize how unusual current alignment is. I want to hear from you. Are you actively tracking metals markets, or did this video introduce new perspective? What sources do you use to stay informed? And again, tell me what city or country you're watching from. Understanding how widespread this awareness is helps everyone. Share this with someone who values data over noise. The next phase of this market will be shaped by those paying attention. Stay informed, stay measured, and stay curious.